In this video, we're going to discuss the fundamentals of pension plan accounting. The matching principle is the underlying concept behind our accounting for pension costs. Recall that we match cost with the revenues they generate by recording an expense. For employees working for us today, they're earning both a current salary and the promise of future retirement benefits or a pension. Both costs are recorded as an expense today. That is, both costs are matched with current revenues. There are two types of pension plans, defined benefit and defined contribution plans. Under a defined contribution plan, the employer will make a fixed contribution determined by the plan to each employee each year. Assets are held by individual employees in their own retirement accounts, and the employees bear the risks of good markets and bad markets. The accounting treatment for defined benefit plans is very easy. The employer contribution to the employee's plan is the pension expense for the year or period. Accounting for defined benefit plans is more complex. In a defined benefit plan, the future benefits are determined by the plan. The employer contribution varies from period to period. Pension assets are owned by a separate legal entity, and the risk is borne by the employer. So, in a defined benefit plan, the employee receives a set amount in the future, and the risk then is borne by the employer. The accounting treatment is difficult. Actuarial assumptions will determine the employer's contribution and the pension expense. And defined benefit plans also involve a pension fund. A pension fund is an arrangement whereby an employer makes contributions or payments into a fund, and that fund then is used to pay future benefits to employees for the services they provide during their working years. This fund is typically a separate legal and accounting entity. Actuaries play an important role in the accounting for defined benefit plans. Actuaries make predictions called actuarial assumptions regarding employee mortality rates, turnover, future salaries, retirements, interest and earnings on plan assets as well as plan obligations, and other factors that are necessary to operate the pension plan. Let's consider a simple example. Employees typically earn a service credit or a future benefit for each year of service or each year of work. These are commonly, say, 2 to 3% per year. A future pension benefit then is a function of an employee's future salary and their years of service. If we assume an employee works for 25 years and accrues a service benefit of 3% per year, then the employee would be entitled to 75% of their future salary during their retirement. And that future salary might be their final year or an average of, say, this last 2 or 3 years that they're working. But notice, that's future salary. We don't know what that's going to be, nor do we know how long the employee is going to be working. That's where the actuarial assumptions come in. Our two questions that we're trying to answer in terms of accounting for our defined benefit plan are: what are the pension obligations or assets should the company report on its financial statements, and what is the pension expense for the current period? We have 3 different conceptual measures to calculate our pension obligation. One conceptual measure is the vested benefit obligation approach. Another we consider accumulated benefit obligations. And the third, the one we use for GAAP, is referred to as the projected benefit obligation. Regardless of our choice, we're going to need to record the liability as the present value of expected future cash flows or expected future payouts under our pension obligation plan. Let's take a look at those different conceptual measures. The first and the smallest pension liability would be under a vested benefit obligation. Under a vested benefit obligation, Benefits are accrued at current salary, and we only accrue benefits that have vested. Being vested, recall, means that the person has a right to the full amount of some benefit, in this case, retirement benefits. So again, under the vested benefit obligation approach, we would only accrue benefits for vested employees and only at current salaries. As time goes on, more of our employees will become vested and our obligation would go up. A second conceptual measure is an accumulated benefit obligation. It recognizes today that even though we have non-vested employees, eventually they will be vested, and we should accumulate an obligation today for that expected future benefit, and we're going to do so at current salaries. The third measure is the most comprehensive. It considers benefits for both vested and non-vested employees, and it does so at our projected future salaries. And again, that's the choice by the Financial Accounting Standards Board, and that's the choice required by GAAP. All of these projected benefit obligations, of course, will be discounted and recorded at the present value of these expected future cash flows. Let's take a look at how we would calculate a company's pension expense. We've got 5 contributing factors to a company's pension expense. It's service cost for the year, interest on the pension liability, actual return on plan assets, the amortization of prior service costs, and gains or losses on the plan's assets. Let's consider these individually. First, the service cost. That's the actuarial present value of the benefits attributed to the pension benefit formula for the employees during the current service period. So going back to this diagram, each year our projected future benefit obligation increases. That change in that benefit obligation will be used to calculate basically the service cost. So again, the service cost is simply how much of that future benefit are they earning for services provided in the current period. The next component is interest on our pension obligation. Interest for the period of the projected benefit obligation is calculated using what we refer to as the settlement rate. Any obligation accrues interest, and our pension benefit obligation will accrue interest at a actuarially determined settlement rate. The next component of our pension expense, actually it's a reduction in our pension expense, is going to be the increase in the pension fund's asset value due to interest, dividends, both realized and unrealized gains, basically the change in the fair value of the plan's assets. Recall, we are contributing money to this pension fund to settle those future pension obligations, and that fund will be earning a return as the stock market goes up or the stock market goes down, as it earns interest or as it earns dividends. So any growth in pension fund assets will reduce our expense for the current period. The next component we're going to consider is the amortization of prior service costs. Often we might amend our pension plan, and these amendments can include provisions that will increase benefits for employees for services they've provided in prior years. We're going to assume, or the theoretical justification then for our accounting treatment, is that these additional benefits will entice the employee to stick around for the rest of their anticipated service years. So what we will do then is we'll take that cost and we will amortize it over the remaining service years for each individual employee. Some people argue that the entire cost should be recorded as a pension expense at the time the plan is amended, but GAAP has taken the position that those costs are a means of increasing the productivity and the term of service for our current employees, and thus we amortize them over the remaining service years. Finally, we're going to consider gains or losses related to our pension fund assets. There's a lot of volatility in the fair value of our pension plan assets, and we can also have significant changes in our projected benefit obligations due to changes in the pension plan. These changes and the volatility in the fair value of assets can cause significant changes in our pension expense. GAAP allows firms to smooth their pension expense by adopting what we will call a corridor approach. We'll discuss that more later. So we have 5 components determining our pension expense for a given period, and we'll record that expense on our income statement. As we make contributions to our pension plan and the pension plan pays benefits, our pension obligation can either have a liability balance, in other words, be underfunded. The projected benefit obligations are greater than the fair value of plan assets, or it can be overfunded. That would mean the pension plan assets are greater than our projected pension benefit obligations. We record this overfunded status on our balance sheet as an asset or a liability. Let's walk through a short example on how we would calculate actual return on our plan assets. We're going to take a look at the Sandhill Corporation. Year-end planned assets were $2,025,000. At the beginning of the period, they had plan assets of $1,810,000. The plan assets have increased by $215,000. If that was the only thing that happened, we would say the actual dollar return on our plan assets was $215,000. But to the extent that we've paid benefits or taken money out of our pension plan, our actual return would have been higher. And in this case, we were told that we paid benefits of $182,000. So in calculating our pension fund actual return, we would add back the benefits that we paid. Of course, if we've made contributions, those would increase the pension plan assets, but they're not part of the pension plan returns. So we would deduct that amount. Let's walk through another problem that will take a look at how we would calculate our pension expense. Recall the 5 components of our pension expense. The following information is for AMR Corporation, that's the parent company of American Airlines. They reported service costs of $366 million, interest on their pension benefit obligation of $737 million. The return on plan assets during the year was $593 million. We have amortization of prior service costs of $13 million, and we have to amortize a net loss on our pension assets of $154 million. Let's go ahead and calculate pension expense for the period. Our service cost is the present value of future benefits that employees have earned during the current period, and that was $366 million. Then our pension benefit obligation is going to accrue interest at the settlement rate, and the interest during our period was $737 million. Again, that's simply our beginning pension benefit obligation times the actuarially determined settlement rate. The pension plan had a return on assets of $593 million. That's the change in the fair value of our pension assets plus any pension benefits paid minus any contributions. We have an amortization of prior service cost of $13 million. Prior service costs arise from changes to our pension plan that increase an employee's benefits due to prior years of service, and we amortize that cost over the affected employee's remaining service years. Finally, we had the amortization of a net loss. Due to market volatility, our pension assets can experience very large swings in values, that is, gains or losses. we use a corridor approach to sort of amortize these gains or losses over future periods. We'll discuss that later. Our pension expense then is $677 million. It's the $366 million service cost, plus interest cost of $737 million, plus the amortization of prior service cost of $13 million, plus the $154 million amortization of pension losses on pension assets, and then we had our pension return of $593 million. Again, increases in our pension assets, the pension return reduces our current pension expense. Let's go through one more short problem. This one involves prior service cost. Shamrock Corporation amended its pension plan on January 1, 2017 and granted $170,280 of benefits to prior service provided by its employees, and we refer to this as a prior service cost. The employees that have been granted these benefits are expected to provide 1,980 service years or years of service in the future. And of those projected service years, 330 of that will be provided in the year 2017. And we're asked to compute the prior service cost amortization for 2017. We amortize that prior service cost, in this case the $170,280, over our expected future service years. So we take the $170,280, multiply it by the fraction of the service that's provided in the current year, and that fraction is 330 over 1,980 for a total of $28,380.